Hello guys, welcome back to my channel. For those who are new here, consider subscribing to my channel. Like this video, click the bell icon so that you are notified whenever I post new content on here for you guys weekly. So today we have a very important indicator. In most cases, traders lose not because they do not know how to do their technical analysis or even how to trade, but because they place their stop losses at places which are so close to their opening position, or they place their stop losses at places which they are not actually supposed to place their stop losses. So this ATR indicator helps you to determine exactly where to place your stop losses to avoid losing unnecessarily. All right, so looking at this indicator, let's assume that you are in an uptrend and you are looking to buy. You've broken through a pivot area and you see a double bottom formation like this. Okay, a double bottom formation, and then you are looking to buy. You are so excited because you have seen a confirmation for a buy, a double bottom. So this neckline of the double bottom has been broken. All right, and you are considering to buy. So now you place your buy order here, okay, just above there, and you're targeting the highs up there. Place your buy order at the close of this candle, and you place your stop loss just below this previous swing low, okay, this previous swing low of the double bottom. You place your stop loss just below there, and sometimes what happens is there's a retracement, aggressive retracement, that returns and takes you out below here. Okay, so now it has taken you down below here with this long wick. So you are out of the trade. And what is funny is that sometimes, in most cases, when the price returns here, okay, it takes you out and returns to go in your previously anticipated direction. So this is painful to watch for all traders. Avoid this by using the ATR indicator to place our stop losses at appropriate places where we are less likely to lose, all right, or where we are most likely to stay in the trade until it matures in our direction. All right, so what we would do is place a horizontal line from our swing low, okay, our swing low there, this one, all right. We'll place our horizontal line from there and to the right, this horizontal line, all right, place there. And this horizontal line, we have to color code it, okay, whichever color you want, so that it will clearly highlight the price over here. As you can see, that price is 2.22032. Okay, so that is the price we see over there. So that is the lowest swing low. All right, so now what we are going to do is we are going to look at our ATR. We are going to place our ATR on the chart, our indicator on the chart, to give us a value which we will subtract from this, value to give us a place of our stop loss, value. Okay, so now we go to our top left corner of the screen, okay, here with trading view, and we will see in where it says indicators. We click there and we search for average true range. So that average true range, when we click on it, okay, and we come back to the chart, this is what we will see. We will see something like this. All right. So here are the peaks, as I've already marked out here. The highest points show higher volatility in the market. This is the peak, okay? And the lowest point here, the lower points here shows lower volatility at the troughs, what I call the troughs, okay? And then the peaks show higher volatility. So where there is higher volatility, the average true range indicator will place your stop loss at a wider so that it can accommodate for the high volatility. Where there is a low volatility, your average true range will give you a figure to subtract or add to the swing low or swing high, okay? So that your stop loss is tighter because there is low volatility. Okay, so as you know, higher volatility will require a wider stop loss to accommodate for that volatility. Okay, so the average true range is a volatility indicator showing the average price variation of the asset within a given period of time. So now when you're about to enter the market and you're placing your buys or sells, like in this case you're placing your buy, you want to know exactly where to place your stop loss to avoid this scenario from happening, okay? To avoid this to be taken out before the market actually rallies in your favor. You want to avoid that from happening. So now you are using the average true range. So we already have this figure at the swing low here, okay, at the previous swing low. Now our average true range, how we are going to get the figure of the average true range to subtract from this figure, all right, is by placing our crosshair, all right, where we bought at. Exactly where we bought at is where we are going to place our crosshair, and then look to our extreme left at the ATR value, okay? It says 0.00201. That is the value the ATR has given us. This is the ATR value, right? Okay, so we will subtract this from this. This is how it would look like, okay? We would say minus. Okay? This minus this. This would be equal to, so what we would get is our stop loss, 218.31. So that is your stop loss. This would be your stop loss. This would be your stop loss figure. All right. So now you take this figure and make a change. You go to this line here, okay, this horizontal line here, okay, and you will right click on that and change the coordinates. You'll change the coordinates to that new figure, 221, okay, 831, and you click OK. So your stop loss is down here, supposed to be down here. So this, if you had placed your stop loss down here, okay, this would not have taken you out. This week would not have taken you out. You would still be in the trade as it goes up into your profit. All right. So this is how you would use the ATR indicator to determine where to place your stop loss to avoid unnecessary losses. So in the reverse, when you are selling in a downtrend and you have area of value this way, all right, so you are looking to sell in that downtrend and you have price dropping and forming, let's use the example of a double top, forming a double top formation like this. All right, let's say it's forming a double top like this. You see that it's an opportunity to sell after the break of this neckline below. You're looking for an opportunity to sell. So you see a bearish candle and you quickly jump in for a sell position. Okay, you quickly jump in for a sell position here. You jump in for a sell position and place your stop loss just above the previous swing high, which is this one. Okay, this one here. All right, so, and you are targeting a 1 to 2, 1 to 3 risk to reward ratio down to the side. Your trade and your technical analysis is spot on, but sometimes what happens is that price returns, falls back up, okay, and takes you out of that trade. All right, with a very long wick or even candles sometimes. Okay, so sometimes this is what happens, and your stop loss is taken out up here, and now you are out of the market because your stop loss has been taken out. And funny enough, this trade sometimes returns in your favor and continues downward in your favor. This happens in many times it happens, okay? And you are frustrated. Why is it always taking me out before it heads in my direction? So it is that you placed your stop loss in the liquidity zone where you are most likely going to be taken out. So we will use the ATR to place our stop loss in a reasonable area or distance away from the liquidity pool. All right, so we'll take a horizontal line and mark it out from this previous swing high there. Okay, that is our previous swing high there. So our horizontal line, this line here, will be marked out from our previous swing high over here. All right, and then there is a value that we see here. All right, that is the value we are going to add to our ATR value to determine where our stop loss would be. So that value right now I see is 2.22419. Okay, that is the value over here, okay, of our swing high. All right, so now we are going to add the ATR value to this number. So what is the ATR value? We take our cursor or our crosshair, place it exactly where we last sold at here, this candle where we last sold at, okay, and look to our extreme left corner, okay, to the ATR value. The ATR value is 0.00114. All right, so this is the value which we are going to add to this value in this case. Because we are selling, the stop loss has to be above, so we are adding. Okay, the result would be our stop loss. The result would be our stop loss. This is the value we find. So this value will be to set our coordinates for our stop loss line. Okay, so we right click on this line and we set the coordinates. We change the coordinates over here to 22533. Okay, and we click OK. So our stop loss, okay, our stop loss would be just close, would just be close to almost to be taken out, right? Would be almost taken out, but not really. All right, so our stop loss would be at this line, and we would have survived would have survived that takeout, that liquidity grab. It's not always perfect, but it works. It really works in most cases to place our stop losses where they need to be. Let's check out how it would be with the real charts. All right, with the real charts, if you this is at resistance. So we see a resistance here, and we see that price has been rejecting these areas. This is a strong resistance. In this uptrend, we see that there's a rejection. Okay, a rejection here. This rejection is bearish candle. They are placing their sells here. They are placing their stop losses just above here, because now after this long week, the trader is placing his sell position here and placing his stop loss just above the resistance there. All right, because he is quite sure this trade is gonna drop. All right, places 1 to 2 risk to reward ratio. But then what happens is the price returns to these areas and takes them out here. Okay, takes them out here before heading downwards all the way. Okay, so how would you avoid this kind of takeout? All right, you take your ATR value. Okay, your ATR value at the candle where you sold at, this candle here, this bearish candle. You'll place your crosshair there and look to your extreme left at the ATR value. It says 0.00134. Okay, so that's the ATR value. That would be our ATR value. All right, we have already determined our ATR value. Now we are looking at the previous swing high, which is this one. All right, which is this swing high. So we place our horizontal line there. That is our previous swing high over there. Okay, this one is our swing high. Okay, and then we go to our extreme right and we read this figure here. What does it say? It says 2.18413. That's what it says. So we are going to add the ATR value to this value to determine our stop loss. That is our stop loss value, 2.18547. 185.47. Okay, so this is the value we would use as new coordinates for this stop loss. Okay, for our stop loss. So this is what we would do. Okay, we'll right click on that horizontal line and change the coordinates to that new value, 185.47, and click OK. So our stop loss should have been way up here to avoid being taken out, and would still target a 1 to 2, 1 to 3, 1 to 2 or 1 to 3 risk to reward ratio, and would still win this trade. If we target the 1 to 2 like this, would still win this trade. All right, so this is now the new value here. Okay, so the ATR value, okay, the ATR value plus the swing high value, okay, equals the new stop loss value. This is the stop loss value, the new stop loss. This is the SL value. Okay, so this value, that value is this value now, where the safe new stop loss is. This is where you would place it. You can see that you are safe off up here. All right, you would not be taken out. In the buying scenario, if you were to buy at this level, if you were to buy here, okay, just think of it as, you know, in a downtrend. Let's say your market is falling in a downtrend like this, okay, in a downtrend, okay, this would be our support area. Let's say this is our support area, okay, this is support. You are looking to buy, all right, so you place you see this kind of formation and you are excited because this is a strong support, okay. There has been a test of that area several times and the price is not breaking below, so you consider buying. You buy from here, you buy at the close of that candle and place your stop loss. You place your stop loss just below here, okay, and then you target all the way up there. Guess what happens? Guess what happens? Okay, the price returns all the way and takes out your stop loss, before heading in your direction. This is a painful experience, guys. It has happened to all traders. So you just have to learn how to avoid this. So the solution would have been, okay, for you to place your stop loss, okay, by placing your horizontal line today, your swing low, this one here, okay. And so this horizontal line, the coordinates for this horizontal line, okay, are 2.156545, okay, that is the number, okay, of our swing low. All right, so now your swing low, you're going to subtract the ATR from your swing low. So what is the ATR? You go to where you bought at, okay, with your crosshair here, all right, here, and then you look to you keep your mouse, your cursor there, all right, or your crosshair at the price where you bought at, okay, or at the candle where you bought at, and you look to your extreme left to the ATR value. It says 0.00129, 0.00129. This is the value you'd subtract from your swing low value. So you take this value and subtract it, okay. You say swing low value minus the ATR value, okay. This is the swing low value, okay, minus that, and then this is what you'd end up with the value for your stop loss, 2.15516. So would have 2.116. All right, so this is our stop loss now. This would be our new stop loss. For this line, we change the coordinates, okay, to 155.16. So click OK. So our stop loss would have been way down here, okay. Our stop loss would have been way down here. To be safe, would have placed it down here, and we would have won this trade easy, okay, even with the 1-to-2 risk to reward ratio all the way up there, okay, and would be safe off here, okay, here, and our stop loss, this stop loss value, okay, the stop loss value would be this one, okay. Our stop loss value would be that one there, okay. So this is how you would use the ATR to actually place your stop losses at safe areas on the chart.